Welcome back to the deep dive. Today we're tackling something pretty big, a what if that honestly sits in the back of a lot of minds in the crypto world.
Definitely. It's one of those, scenarios people maybe whisper about or just completely dismiss.
Exactly. We're talking about Bitcoin, not just a dip, not even a major correction like we've seen before.
No, something much more drastic.
We're asking, what if Bitcoin totally crashed, like spiraled down, maybe even close to zero?
It sounds almost unthinkable, doesn't it? Especially to people who've been in the space a long time.
It really does. But for anyone trying to navigate this whole digital economy thing, it's a possibility you kind of have to examine, right? Rigorously, impartially.
Absolutely. I mean, so much focus is always on the upside, the to-the-moon scenarios, which is exciting, obviously.
Sure.
But understanding the extreme downside is, well, I'd argue is just as important, maybe even more so.
I agree. And we've gathered quite a bit of material for this. Financial reports, academic papers, market analyses.
Yeah, and taken together, they paint a pretty vivid and frankly quite unnerving picture of what that kind of event could look like.
It lets us test the resilience, not just of crypto itself, but also how it connects back to, the traditional financial system.
The intertwined nature of it all, that's key.
Exactly. So our goal today isn't just to speculate wildly or spread fear.
No, not at all.
We want to really dive deep into what total crash actually means in this context. We'll explore the potential domino effects, across markets, institutions.
And crucially, how it might impact individuals, your own financial situation if you're involved in this space.
Right. So get ready. We're going to unpack some potentially surprising facts and take a really thorough look at these interconnected risks, the extreme edges, really. ## I. Defining the total collapse scenario and initial market impact. Okay, so first things first, let's get clear on what we're actually talking about. Definitions matter here. A 20% drop, even 50%. That's kind of crypto 101, isn't it? Painful, yeah, but familiar.
It is. We've seen those cycles. But a total collapse is fundamentally different. It's a different beast entirely.
So when we say totally crashed, what are we really defining? What's the threshold here in this hypothetical?
Well, the sources we looked at are pretty clear on this. They make a critical distinction. It's not just another big price drop.
Not just a bad bear market.
Exactly. We're talking about something almost existential for Bitcoin. A collapse of its value so severe that it falls drastically, maybe even approaches near zero.
Near zero. Wow.
Yeah, it signifies a fundamental loss of its perceived utility, a complete wipeout of confidence in its role as, say, a store of value.
So it's not just the price number changing, it's the whole narrative unraveling, the whole reason people hold it?
Precisely. Imagine its market cap just shrinking to almost nothing. It reflects a kind of consensus, a collective agreement that it just doesn't do what people thought it did anymore.
Okay, so definitely not just a rough patch. It's more like a fundamental questioning of its entire reason for being, its future.
That's a good way to put it. A philosophical questioning almost.
Imagine waking up to that. Bitcoin down 90%, 95%, maybe even 99%. It's hard to even picture.
It is. And think about what that means beyond just the direct holders. What about all the assets collateralized by Bitcoin and DeFi?
Right, all those loans?
Or just the basic psychological impact on the entire crypto space? If the king falls that hard.
What hope is there for anything else? Yeah. The sources really frame this as the ultimate stress test, don't they? For the whole ecosystem.
They absolutely do. It would force an immediate and probably brutal reevaluation of everything associated with Bitcoin, the digital gold narrative.
It's the inflation hedge idea.
Decentralized safe haven.
Yeah.
All of that. If an asset built on those powerful stories loses 99% of its value, that whole framework just collapses instantly.
And the psychological fallout would be immense, wouldn't it? Spreading way beyond just Bitcoin holders.
Absolutely. It becomes a crisis of faith. People would inevitably ask, if Bitcoin can fail so spectacularly, what's the real enduring value proposition of any of these other coins or projects? Especially those that kind of derive their legitimacy from Bitcoin's dominance.
It is a chilling thought. Keeps you up at night, even if you're a believer. Okay, so we have this stark definition. A near total loss of value and confidence. Let's move to the immediate aftermath. If the unthinkable happens, what are the very first things to break? What do those initial shockwaves feel like?
Instantaneous.
Ooh.
Brutal. Far-reaching, that's what the analyses suggest. Bitcoin's collapse would almost certainly trigger a massive wave of liquidations.
Okay.
Losses would domino through everything. Altcoins, CeFi platforms, DeFi protocols, you name it.
And investor confidence.
Evaporates.
Yeah.
Just gone. leading to widespread panic. Confidence is fragile in these markets in the best of times, right?
Absolutely. And it wouldn't be contained, would it? You always hear about how interconnected crypto is.
Exactly. A Bitcoin collapse wouldn't happen in a vacuum. It wouldn't just send ripples. It would be more like a tsunami hitting every part of the digital asset world.
Okay, walk us through that. Those first terrifying moments. What breaks first?
The first and probably fastest effect would be these cascading liquidations. Think about how many people use leverage.
Margin trading, yeah. Borrowing to amplify bets.
Right. Institutions, retail traders,
Mm-hmm.
they borrow funds, often using their Bitcoin as collateral to increase potential returns. Great when prices go up.
Devastating when they plummet.
Precisely. As Bitcoin's price crashes in our scenario, these leveraged positions instantly become underwater. They fall below the required collateral level.
And the platform's forced sell.
Automatically.
Yeah.
Smart contracts or exchange rules trigger forced liquidations. They sell the Bitcoin to cover the loan, but selling into a collapsing market,
Just pushes the price down even faster.
it's a vicious feedback loop, a self-reinforcing downward spiral. And it's not just margin trades. Anyone who borrowed against their Bitcoin may be taking out a stablecoin loan,
Same problem. Their collateral value evaporates.
leading to margin calls they can't meet, and again, more forced selling. It's a rapid, incredibly destructive unwinding process.
So it's not just direct holders feeling the pain, it's this huge network of borrowers and lenders all caught in the same downdraft. Sounds like a wildfire.
It really does. And the fire spreads quickly. The next immediate impact, altcoin contagion.
Ah, right, because so many alts are priced against Bitcoin.
Exactly. Most altcoins don't trade directly against, say, the US dollar primarily. They trade against BTC or maybe ETH. So if Bitcoin crashes,
Their dollar value craters too, even if their BTC price holds steady.
disproportionately so. Often even worse than Bitcoin itself. Even if an altcoin somehow magically held its value perfectly against BTC, its USD value would plummet simply because the base pair Bitcoin is collapsing.
So an immediate, unavoidable, and probably catastrophic drop across the board for altcoins.
Pretty much instantaneous. In moments of extreme fear like that, correlations tend to go towards one. Everything moves together, down. Very few assets would be spared.
And the human factor, investor confidence, that must just shatter.
Completely. The psychological impact would be immense. We'd see panic selling on a massive scale. Not just Bitcoin, but everything digital.
A flight to safety.
Absolutely. People desperately trying to get into cash, stablecoins maybe, or traditional assets, selling anything they can, which just exacerbates the losses across the entire market. It creates this deep sense of capitulation.
Like everyone just gives up hope.
Right. Our sources actually talk about visualizing this as a simulated crash map. It shows these cascading losses, BTC, ETH, DeFi, TVL, CeFi exchange reserves, all tumbling down.
It paints a picture of a very complex, very rapid unraveling, like a digital earthquake.
That's a good analogy, shaking the very foundations.
Okay, a digital earthquake indeed. With aftershocks hitting every corner. Let's zoom in now. How does this play out specifically within the crypto ecosystem? Particularly in DeFi, that world of decentralized finance. Hashtag tag Shag2, the crypto ecosystem fallout.
Right. Within the ecosystem itself, DeFi represents a particularly vulnerable area in this kind of scenario.
Interesting, because DeFi is often presented as being more resilient, right? No single point of failure.
In theory, yes. But its core lending and collateral models are heavily, fundamentally reliant on the value of the underlying crypto assets.
So if Bitcoin crashes,
It could pull countless stablecoins, lending pools, everything underwater. It has the potential to spark a really severe systemic DeFi crisis.
oh, okay, so let's unpack that. DeFi is built on things like over-collateralization. How does that hold up in a 90% plus Bitcoin drop?
That's the critical vulnerability. Over-collateralization works fine in normal volatility. You deposit, say, $150 worth of BTC to borrow $100 USDC. That buffer protects the lender.
But if that $150 of BTC suddenly becomes worth like $15,
Exactly. Your position is instantly massively under-collateralized. And the DeFi protocols, the smart contracts, are programmed to react automatically.
they liquidate the remaining collateral.
They have to. They forcibly sell off what's left of your Bitcoin to try and recoup the $100 loan and prevent the protocol itself from taking a loss, from accumulating bad debt.
So the very mechanism designed for safety in normal times.
Becomes an accelerant in a crash. It adds huge, relentless selling pressure right when the market can least handle it. The system, trying to save itself, actually helps drive the collapse faster within DeFi.
Wow. Okay. And what about stable coins? We tend to think of them as, well, stable, but you mentioned risks there too.
Yes, especially the more complex ones. Most stablecoins aim for that 1.1 peg with fiat, like the dollar,
Yeah.
often backed by real-world assets. But some, particularly algorithmic stablecoins,
Like Terra Luna, UST.
exactly like Terra Luna, that's the prime example our sources point to. They don't rely on traditional backing. They use complex algorithms, mint-burn mechanisms, maybe collateralized by other volatile cryptos.
And Terra showed how badly that can go wrong.
Spectacularly wrong. Billions wiped out. Massive DeFi contagion. It proved that under extreme market stress, the kind of Bitcoin collapse would definitely generate, those algorithmic pegs can break,
The mechanism failed.
leading to depegging, death spirals, and a complete loss of trust. It could trigger a much wider crisis across any DeFi protocols relying on those types of stablecoins.
That Terra collapse really was a wake-up call. It started with something meant to be stable. Okay, and the basic lending pools, where people deposit assets to earn yield and others borrow.
Their ability to function, to actually repay users, would be severely compromised. Imagine a lending pool where a huge chunk of the deposited assets, the collateral backing the loans, is Bitcoin.
If that value plummets,
The pool might simply not have enough remaining value to cover all the withdrawal requests.
Okay.
You'd get a liquidity crunch, essentially a DeFi bank run.
people rushing for the exits, but the exits are jammed.
Precisely. It could lead to protocols becoming insolvent. It would be an unprecedented test of their design and their underlying economic models.
So DeFi faces this potential systemic crisis. But it's not just the decentralized world, is it?
Yeah.
Centralized platforms, the big exchanges and lenders, they're also at risk.
Hugely at risk. Centralized finance, or CeFi, we're talking major exchanges, large crypto lenders, custodians, they face immense, multifaceted pressures too.
And history has shown us, like with FTX, that when a big CeFi player fails,
The fallout can be massive. It can domino through the entire crypto market and even potentially spill over into traditional finance.
these CeFi platforms handle enormous amounts of user money. They're often the main entry point for people. How are they vulnerable?
Well, they hold vast sums, billions, sometimes trillions in user assets. And many aren't just holding, they're actively engaging in their own lending, trading, investing, often with user funds.
Which isn't always transparent.
Exactly. Unlike a public blockchain, CeFi operations can be quite opaque. So if Bitcoin crashes, it puts enormous financial stress on them. Do they have adequate reserves? Have their own investments soured?
If they made risky bets that go wrong.
They could face severe solvency issues very quickly. And it's hard for users to know the true state of their finances until it's too late.
And we saw this play out so vividly so recently.
We certainly did. The FTX collapse is the starkest reminder. A huge, seemingly reputable exchange.
It just imploded.
And it wasn't just FTX users who got hurt. It spread like wildfire. Other firms, lenders, VCs who were exposed. It shook confidence globally.
It really exposed the dangers of mismanagement, lack of transparency.
And crucially, the commingling of customer funds with the platform's own risky trading activities. That was the killer blow for FTX. Billions evaporated.
It's chilling how fast trust can be destroyed, and in that kind of panic, everyone tries to get their money out at once, right?
That's the natural instinct. You'd see the crypto equivalent of a bank run, but happening digitally at lightning speed.
Exchanges get overwhelmed with withdrawal requests.
Massively, leading to liquidity crises.
Yeah.
And the dreaded withdrawal freeze. Platforms just halt withdrawals because they physically can't meet the demand.
Trapping user assets.
Exactly. Amplifying the panic, the anger, the despair. Widespread failures like that wouldn't just hurt individuals, they'd decimate trust in all centralized crypto platforms. It could push people away from the space entirely, maybe permanently.
Okay, so the crypto ecosystem itself, DeFi and CeFi, takes a massive direct hit. But the shockwaves you suggested might not stop there. How does this spill over into the broader traditional financial world? Hashtag tech3, broader financial and systemic risks.
Right. This is where we need to look beyond the crypto bubble, so to speak, and trace the connections to traditional finance. The sources suggest a mixed picture, actually.
Oh, how so?
Well, on one hand, major regulated banks seem relatively insulated from direct crypto exposure. They aren't holding vast amounts of Bitcoin on their balance sheets, generally speaking.
Okay, so that limits one kind of direct contagion.
It does provide a sort of fire break for direct systemic risk to the banks themselves. However, that doesn't mean there's no risk to the broader economy.
Because other companies do have exposure.
Exactly. Companies that have piled Bitcoin onto their corporate treasuries, or firms that have taken out traditional loans backed by their crypto holdings, they could face insolvency.
And that could create indirect systemic risk.
Potentially, yes. It's a more complex pathway, but a real one.
This is fascinating, where the digital and traditional overlap. We know some big publicly traded companies made headlines putting Bitcoin on their balance sheets. What happens to them in a total crash?
That strategy suddenly looks incredibly risky, doesn't it?
Mm.
What was praised as innovative becomes a massive liability overnight,
Their balance sheets get hammered.
severely impaired.
Mm.
Imagine a huge write-down on a core asset. This could easily lead to their stock prices collapsing, credit ratings being slashed.
Making it harder for them to borrow.
Exactly. And in the worst cases, for companies where Bitcoin was a really significant part of their treasury, it could genuinely lead to bankruptcy. It's a direct hit to their financial stability.
From visionary asset to existential threat? Wow. And what about firms that borrowed against their crypto, using it as collateral for traditional loans?
They're in even more immediate trouble. A Bitcoin collapse triggers instant, massive margin calls on those loans.
They need to post more collateral, probably cash.
Right. Or face forced liquidation of their remaining crypto assets to pay back the loan. Many simply wouldn't be able to meet those calls.
Leading to financial distress, forced selling, possibly insolvency again.
Absolutely. It creates this very clear bridge for crypto losses to directly impact and potentially break traditional corporate entities.
Okay, so maybe the big banks are okay directly, but if major corporations start failing because of crypto, that has to ripple outwards, doesn't it? How does that indirect risk play out?
Think about the consequences. A large public company goes under. That means job losses, potentially thousands.
Economic hardship for families.
Disruptions to supply chains if they were a key player in an industry. Manufacturing, retail. The effects spread.
Investor confidence takes a hit too, even in traditional markets.
Definitely. If investors see established companies failing due to crypto bets, it makes them nervous about everything. It could trigger a broader market sell-off.
And even if banks don't hold Bitcoin directly, they might have lent money to these companies, right?
Right.
Or hold their bonds.
Exactly. So the banks could still take substantial indirect losses through their traditional lending or investment activities. It creates this complex ripple effect through the economy, impacting credit availability, investment sentiment, the whole nine yards.
It really does sound like a house of cards. Maybe not the foundation card, but pulling out a key corporate card could still cause major wobbles, maybe even a collapse.
That's a good way to think about it. The interconnectedness is key.
Which brings us back to the individual. How does all this direct crypto losses, corporate failures, market jitters ultimately impact ordinary people?
Before we get right into the personal impact, it's worth just quickly reiterating that point about the bank's direct insulation.
Right, the fire break.
Yeah, the major regulated banks in places like the US and Europe generally have minimal direct holdings. So a 2008-style crisis originating directly from crypto hitting bank balance sheets seems less likely based on current structures.
That's somewhat reassuring. But you mentioned the indirect economic fallout. How does that hit Main Street, even if the banks themselves are okay?
It's more insidious, but definitely impactful. If lots of companies or wealthy individuals face financial ruin due to crypto,
Lenders get nervous.
exactly. Banks and other lenders see increased risk, potential defaults. They naturally become more cautious. They might tighten credit standards, lend less, or charge higher interest rates.
Making it harder for businesses to borrow for expansion or for people to get mortgages, car loans.
Precisely. A credit squeeze. That can significantly slow down overall economic growth, impact job creation, affect everyone's prosperity.
And could governments be forced to step in?
In a really severe scenario, absolutely. There could be immense pressure for bailouts, relief programs, propping up industries.
Which has fiscal consequences. Higher debt, maybe higher taxes down the line.
Potentially, yes. Sources like the New Yorker piece on systemic risk explore this evolving concern. The direct links might still be forming, but the potential for indirect systemic risk through corporate failures, credit markets, and potential government action is definitely a growing worry for policymakers.
Okay, so the nation's economic health is one thing, but let's get really personal now. The economic health of individual citizens, particularly younger people who really embraced crypto. This is where it hits home. Hashtag #AVD, human and generational impact.
This is absolutely where the abstract market crash becomes deeply personal tragedy for many. The data consistently shows millennials and Gen Z have allocated often a much larger slice of their savings to crypto compared to older folks.
So for them, a crash isn't just numbers on a screen.
It could be catastrophic, wiping out retirement savings, destroying plans for buying a home, plunging people into serious personal financial crises.
And potentially making inequality worse.
Tragically, yes. It could really exacerbate the wealth gap.
Why is there such a generational divide here? What drove younger people towards crypto so strongly?
It's a mix of things, really. Younger generations face unique headwinds, right? Sky-high housing costs, massive student debt burdens.
Wages maybe not keeping pace.
Exactly. So traditional paths to building wealth, like just saving or low-yield investments, they can feel slow, inadequate, almost impossible for some.
And crypto offered this promise of rapid growth, democratized finance.
Precisely. It felt like a viable path, maybe the only perceived path for some, to achieve significant wealth accumulation or financial independence. So, understandably, they allocated a higher percentage of their savings there compared to, say, baby boomers with more traditional portfolios.
So we're not just talking about fun money or small side bets for many of these younger investors.
No, absolutely not. For a significant number, these crypto holdings are foundational. They're part of the long-term retirement plan, the house down payment fund, the seed capital for a dream business.
A total crash would just obliterate those dreams.
Utterly. It wouldn't be a setback. It would be starting over potentially decades behind schedule. It forces a complete, painful recalculation of their entire future. There are articles, like one from Go Banking Rates, specifically about this, how an 80% plus crash would be devastating for individual futures. It breeds disillusionment.
And the impact on inequality, you mentioned that. How does a crash worsen it?
Well, unfortunately, it's often those with less financial cushion who are drawn to higher risk, higher reward assets. They're trying to catch up, trying to escape precarity.
So they're disproportionately harmed when those assets collapse.
Exactly. A crash like this would wipe out their savings, possibly any hope they had of upward mobility. It just widens that already vast gap between the haves and have-nots. Some analyses visualize this quite starkly, showing crypto as a much bigger slice of Gen YZ savings compared to older generations. It's a serious social concern.
Beyond the brutal financial toll, there's the psychological impact too, isn't there? The regret, the fear, the anger, and how it changes perceptions long term.
That's a huge piece of it, often underestimated. A collapse isn't just economic, it's deeply psychological. It would almost certainly trigger urgent calls for heavy-handed regulation.
Crackdowns on exchanges, on DeFi.
Definitely. And perhaps most damaging in the long run, it would profoundly erode mainstream trust and sentiment towards crypto. It could stall widespread adoption for years, maybe even decades.
The erosion of trust. That seems key. If Bitcoin, the poster child, essentially fails, how does the public ever trust any digital asset again?
It would be incredibly difficult. The industry would struggle massively to regain credibility, to shake off the image of being just a risky speculative casino. The narrative would shift completely.
From innovation and freedom.
To risk, instability, scams, and loss. Sources like PrimeXBT and The New Yorker talk about these psychological domino effects. It could create a deep, pervasive public skepticism that's very hard to overcome.
And that public anger, that loss of faith, inevitably fuels a regulatory backlash, right?
Without a doubt. Governments, financial authorities, many already skeptical, would face immense pressure to act forcefully.
Leading to swift, maybe very strict new rules.
Almost certainly. Stringent regulations, possibly bans on certain things, heavy oversight. There's this idea of a regulatory reaction timeline suggested by some sources, basically. Expect rapid, significant policy changes globally right after a crash. It wouldn't just be tweaking rules, it would be fundamentally reshaping the landscape.
So that big vision, crypto for everyday payments, institutions fully embracing it, that gets pushed way back.
Significantly. Potentially for a generation. The perceived risks would just dwarf any perceived benefits for most people and institutions.
Yeah.
It'd be a major, major setback for the whole digital asset experiment, potentially relegating it back to a niche, high-risk fringe. A huge blow to those early ideals. Hashtag V regulatory and future landscape.
Okay, so if this catastrophic event unfolds, painting a pretty bleak picture, what's a long-term outlook? For crypto itself and for this drastically changed regulatory world it would find itself in. We've mentioned regulation, but let's get more specific. What would that likely look like?
It would be a defining moment, no question. A watershed for global regulation. Governments would move fast, with urgency. We'd almost certainly see comprehensive, sweeping new rules.
Like what specifically?
Much stricter licensing for everyone, exchanges, custodians, maybe even DeFi protocols in some form. Mandatory capital reserves like banks have would likely become standard for platforms holding customer funds.
And consumer protection.
Huge focus there. Robust, legally enforceable measures to safeguard user funds, prevent fraud, ensure transparency, things that are often lacking now.
So basically dragging crypto into a much more traditional financial regulatory framework, the Wild West days would be truly over.
Absolutely, that's the consensus. And alongside broad frameworks, expect targeted crackdowns, unregulated exchanges, DeFi protocols operating in those murky legal gray areas.
They could face outright bans, severe restrictions.
Very likely, leading to a significant shrinking of the decentralized space as we currently know it. Regulators would want to shut down avenues for illicit finance or investor harm.
And this would need to be international, wouldn't it, given crypto's borderless nature?
Correct. You'd see much stronger international cooperation to standardize rules, trying to prevent regulatory arbitrage companies just moving to the jurisdiction with the weakest rules.
Aiming for global financial stability.
Right. That regulatory reaction timeline idea suggests this would all happen quite quickly and globally, creating a much more harmonized, though likely much more restrictive, environment for crypto worldwide.
Okay, so devastation, followed by a potentially stifling regulatory crackdown. It sounds pretty grim. But is there any scenario, however counterintuitive, where this could be seen as a positive? Could a crash this big actually be a healthy reset for the space, or is that just wishful thinking? Is it just pure devastation?
That is the really provocative question, isn't it? And it's something some sources, like that Time article, could a crypto crash brought a better future, genuinely grapple with.
It seems hard to imagine anything positive coming from such loss.
The immediate pain would be immense, undeniable. But there's an argument, a perspective, that a severe crash could act as a necessary, albeit brutal, cleansing fire.
How so? What gets cleansed?
Primarily the speculative excess. A crash would likely wipe out the vast majority of purely speculative projects, the meme coins with no utility, the poorly designed protocols, the unsustainable business models built only on hype.
Leaving behind.
Hopefully, the projects with real substance, the robust technologies, the innovations with genuine utility, strong fundamentals. It would be a harsh market correction, weeding out the froth and nonsense.
Forcing a shift in focus, away from just price speculation.
Exactly. The intense pressure would force the industry to focus on real-world utility, on creating fundamental value, on sustainable economic models. Development would have to shift toward applications that solve actual problems, not just ones that promise quick riches through clever marketing.
A forced maturation, maybe?
Yeah, you could call it that. A very painful one, but potentially leading to a more mature industry. And it would also force the survivors to build much stronger foundations.
Better security, more transparency.
Absolutely. Best practices would become essential for survival. Prioritizing consumer protection wouldn't be optional. This could lead, eventually, to a more resilient, more trustworthy ecosystem. So yes, immediate devastation, deep scars. But paradoxically, maybe a path towards a more stable, genuinely innovative, and better integrated digital asset space could emerge from the ashes. It's a challenging thought.
To make this less theoretical, it really helps to look back at past crises within crypto itself. Even though it's a young market, it's had its share of spectacular blowups. Our sources point to a few key examples that act like mini blueprints. Let's start with Terra UST and LNA.
You're right, the Terra collapse is a huge one, absolutely devastating. It showed how quickly things can unravel, especially with algorithmic stablecoins. Billions vanished, and the contagion spread throughout DeFi.
That story was everywhere. What was the core lesson from Terra's failure?
It really highlighted the fragility of stablecoins, not fully backed by traditional liquid assets. UST relied on this complex algorithm with LNA to maintain its peg to the dollar.
And the algorithm broke under pressure.
Spectacularly. When big players started selling heavily, the mechanism couldn't cope. It entered that infamous death spiral. Both UST and LNA went to practically zero within days. It proved these complex algorithmic pegs, without sufficient real-world backing, can be incredibly unstable and fail catastrophically under stress.
And the damage wasn't contained just to UST and LNA holders, right?
Yeah, not at all. Because so many other DeFi protocols were using UST or holding LNA as collateral, the collapse triggered massive losses and liquidations across the board. It really hammered home how interconnected DeFi is. The failure of one major piece can cause system-wide panic and billions in losses. It's a chilling preview of what a larger crash could entail.
A very painful lesson learned there. Okay, another example mentioned is the Iron Finance bank run with the Titan token. What happened there?
Iron Finance and Titan is another cautionary tale, maybe smaller in scale than Terra, but illustrating similar risks around tokenomics. It was another protocol failure built on what turned out to be unstable economic incentives.
Unstable tokenomics sounds ominous. What went wrong?
It exposed the risks of overly complex or poorly designed models. Titan was part of another fractional algorithmic stablecoin system. When a few large holders started selling Titan aggressively, it tanked the price.
Triggering a loss of confidence.
Exactly. A rapid loss of faith led to a frantic bank run. Everyone rushed to sell their Titan and get out. The protocol's economic model, which needed continuous demand and this delicate balance, just collapsed under the selling pressure. Titan's value evaporated incredibly quickly, almost overnight.
That term bank run really captures the panic, doesn't it? Even in a digital context.
It absolutely does. It shows how fast sentiment and liquidity can just vanish when fundamental design flaws are exposed or when trust breaks. It's another relevant parallel for understanding how quickly things can cascade downwards in a broader market crash, especially if core mechanisms are unsound.
And finally, perhaps the most recent and impactful example, showing risks even in the centralized world, the FTX collapse.
Yes, FTX. Its failure and the market ripples that followed are probably the starkest recent example of how a major centralized player collapsing can cause widespread contagion, hitting both crypto and even touching traditional finance. It was a massive wake-up call about centralization risk.
The repercussions are definitely still being felt. What were the absolute key takeaways from FTX beyond just the fraud?
It highlighted the dangers of opacity and lack of oversight in CeFi. FTX was mixing customer funds with its own risky trading arm, Alameda Research. They were using billions in customer deposits to make huge leveraged bets.
Something unthinkable in regulated traditional finance.
Completely illegal, yes.
Yeah.
And when those bets went bad and customers tried to withdraw, the house of cards collapsed. But the failure wasn't isolated.
It dragged others down too.
Absolutely. It caused a chain reaction. Major lenders like BlockFi and Genesis went bankrupt. Countless other firms, VCs, anyone exposed to FTX or Alameda suffered huge losses. It showed how the failure of one giant intermediary can trigger a systemic crisis within crypto, shattering confidence globally.
And it really exposed the regulatory gaps, didn't it?
Massively. It underscored the urgent need for much clearer rules, consumer protection, and stricter oversight for exchanges to prevent anything like it happening again. FTX made the theoretical risks feel incredibly real and tangible, serving as a clear preview of the potential systemic impact of an even bigger event, like a Bitcoin crash.
Right. These examples, Terra, Iron Finance, FTX, they aren't ancient history. They provide really critical, tangible context. They show the speed, the scale, the interconnectedness, and the devastating mechanics of how these collapses can happen. It definitely moves the idea of a Bitcoin crash from a purely abstract what if to something with very real, painful precedents. Hashtag tag outro.
Wow. Okay, so we've really journeyed through a complex and frankly, often unsettling scenario today. We've traced the potential path of a hypothetical Bitcoin collapse right from the initial shockwaves.
There's the vulnerabilities in DeFi and CeFi.
To the risks for corporations holding crypto, and then the really profound personal impact on individuals, especially those younger generations. And we also explored that inevitable regulatory reaction and wrestled with that difficult question. Could it be a reset or just pure devastation?
What really stands out from digging into all these sources is just how deeply interconnected everything is. Crypto within itself, and increasingly crypto with the traditional financial world.
Absolutely. A major event involving Bitcoin wouldn't be contained. It would ripple outwards, affecting investment strategies, government policy, the future of innovation, everything. The risks are layered and complex.
But interestingly, the sources also hint at resilience, don't they? At the potential for the industry to learn, adapt, evolve, even after massive shocks.
There is that potential, yes. Amidst the warnings, there's also a thread of how crisis can sometimes force necessary change.
Which leaves us, and you, our listener, with a final provocative thought to consider. Could a total Bitcoin collapse, as devastating as it would be in the moment, could it ultimately force the kinds of changes, the robust regulations, the focus on real utility, the stronger foundations that actually make the broader digital asset space more resilient, more secure, and maybe better integrated in the long run?
Or would the damage just be too great? Would it be a permanent setback, pushing crypto back to the fringes, forever marked as a failed experiment? A cautionary tale.
It's a tough question with no easy answer. What really stands out to you from everything we've discussed today? We genuinely hope this deep dive exploring the extreme edge case of a Bitcoin apocalypse has given you valuable perspective on the risks, the complexities, and maybe even the potential evolution of this volatile space.